Okay, we'll get going here. Welcome everybody to our fourth installment of our Masters of 504 webinar series. We appreciate very much your participation in this and also Brooks Harbertson's availability to teach us today. Before we get started and my introduction of Brooks and the topic, just wanted to get something really quick on your calendars for all of those of you that are in the Utah area. On Thursday, July 21st, the evening, Mountain West, we have rented out a water park, Cowabunga Bay, for our summer kind of party. We'd like to invite all of our lenders and agents and brokers and all those affiliated with Mountain West to come and attend that with their families. So if you're on this webinar, you're most likely on our mailing list, and you'll be seeing that save the date go out probably tomorrow. And then if you can just RSVP if you're coming, and also with the amount of family members that will be coming with you, so we can get a head count for that. But that will be Thursday, July 21st at the water park, Cowabunga Bay, just off of I-15 in kind of the Sandy Draper area. So without further ado, I'd like to just introduce that this subject matter that we'll be covering today is Eligibility 101, and will be taught by Brooks Harbertson, one of our loan officers located in our Utah County office. We're very appreciative for Brooks for instructing us today. Brooks has been with us now for a couple of years, and prior to that, he had a banking career, which was at Mountain West Bank, Zions Bank, and some others. And so we're very appreciative to Brooks for instructing us today. I will be monitoring the chat and question and answer boxes. So if you have any questions, please just plug those in there, and we'll either interrupt Brooks to ask the question if it's a subject matter he's addressing right now, or we'll take them at the end. So Brooks, with that, take it away.
Thanks, Danny. Thanks everyone for joining us. I'm going to go ahead and share my screen here for a minute. We can get started. No need to adjust your screen. That is my face. My actual face, but hopefully not for long. All right, let's see here. As Danny mentioned, we're going to be talking about eligibility. This is really surface level eligibility. So keep in mind that we will be covering deep dive eligibility in our next month's presentation. One thing we won't really cover, we may touch on it slightly today, is there are two refinance programs, conventional refinance and refinance with expansion. We probably won't get too much into detail about those. If you have specific questions about debt refi, that's coming up. I know Curtis will touch on it briefly next month, and then Judd will be tackling those two topics again in the near future. So when we talk about eligibility, we're really referencing what we call the SOP. The SOP is our guideline that tells us which rules we have to follow. We used to have Mike, who was our true guru in what was eligibility. Well, now we have Jeff Vancherry, so he's got a little bit of that in him, and then Curtis does too, so that's why he's going to tackle deep dive into eligibility. One thing to think about is eligibility is constantly changing. We don't expect you to be experts in eligibility. That's our role. And we're constantly learning. As each SOP changes, the rules regarding eligibility and how SBA loans are analyzed can change. And so we're constantly learning and expanding our knowledge base as it relates to eligibility. So when we look at a credit, let's talk about why SBA cares and why you should care about eligibility. We evaluate credit just like a typical bank would. We're concerned about the 5 C's of credit, but we have this E to deal with referring to eligibility. And eligibility is crucial to SBA's mission. In fact, it's a key component of the mission. And without it, we can't do a 504. So even though you may evaluate a credit from the 5C's perspective and think, oh man, this is a slam dunk, it may actually not be eligible. One quick example of that is we recently submitted a loan where it met every eligibility criteria, but when we submitted it to SBA, they said, well, this borrower has too much cash. They don't meet the credit elsewhere test. And so it actually got declined. So just because a deal seems like a slam dunk on your end doesn't necessarily mean it's eligible per SBA. So let's talk about it early. I guess that's our main encouragement to you, is let's talk about it early. So public policy is one of those things that's integral to the 504 program. Every 504 loan that we do requires jobs to be created. We work with the U.S. Small Business Administration. Their role is to help small businesses grow. And so a key component of this program is that we create jobs. In addition to creating jobs, I won't go through each one, but you'll notice that there are other public policy goals that SBA would like us to meet. Just a few examples: women-owned business, minority-owned business, opportunity zone, rural community. Those are examples of other public policy goals that we would like to meet in addition to the job creation. So how can you use SBA proceeds? Most of you that are on this call today have probably done a 504. So you're familiar with some of the basic uses of funds for a 504. So those could be purchase a building, change or renovate an existing building already owned by a borrower, build a new building, acquire fixed assets. Typically, when we talk about fixed assets, we're talking about large pieces of equipment, durable equipment, manufacturing, etc. This is one section where we'll just touch on refinance, but we can refinance certain debts, and we can provide cash for eligible business expenses, and that will be covered more later on. Also, you'll see a number of other things. Certain soft costs are eligible. Thinking of those things like appraisals, environmentals, interim interest if you're doing a construction loan, and contingency for construction loans. And then also improvements to a property under construction. What's not eligible? If a lender is trying to convert a loan from a conventional loan to a 504 because they may lose money if they don't otherwise, that is not eligible. Third-party loan fees are not eligible. Other things like working capital, franchise fees, advertising, those are not eligible uses of funds. You may ask, well, they are on 7A, and that is correct. They could be eligible under SBA 7A program, but not the 504. Now the next one, fixed asset project components. Some of you may say, well, I've done a deal where we've done some furniture and equipment. On a new construction deal, as long as it makes up a minor component of the project, those are eligible. But we can't use it for, say, furnishing a large office building, and that's the only component of the financing. We also cannot finance rolling stock, so really anything with wheels that has a VIN number, and then anything that's construction equipment that's not durable equipment. So heavy construction equipment could be considered, but it has to have a useful economic life or usable life of 10 years or more. So what kind of companies are eligible? They have to be for-profit. The types of entities are listed here for you. These are probably types of entities that we're all familiar with: corporations, partnerships, LLCs. The company borrowing money needs to be located in the United States. It must meet what we call the alternative size standard, which is the net worth of any company or companies included in the transaction cannot have a net worth of over 15 million or net profits above 5 million. So affiliates could be a co-borrower, a guarantor, an affiliate. Jeff Van Cherry will cover affiliation more later, but any company that's essentially owned by the same group of individuals would get lumped into this analysis. So if it exceeds these numbers, then it doesn't meet the size standard. We do have other ways to analyze it, but this is the standard way that we use. And the property has to be owner user. Obviously, this is made for businesses to grow and so we want them to occupy the majority of the property. In an existing building, that means 51%. If it's new construction, they have to occupy 60% once construction's complete. We'll talk about that a little bit more here in a minute. You can have more than one business that occupy a space, and as long as combined as co-borrowers, they occupy the minimum requirement, then they can be considered for application. In addition to the types of companies, they have to meet those economic development goals, and we require, in our case, participation with another lender. That's typically one of you. So we cannot do this program on our own. And in fact, you cannot do the 504 program on your own, which is different from a 7A. So we require each other to get this thing done. So ineligible companies. The list is pretty long. I won't go through all of them. We will provide you the slides after if you'd like. But the key ones are, it cannot be a nonprofit. It cannot be engaged in lending. And you'll see there are some circumstances that eligibility changes when it's a pawn shop or a mortgage servicing company. And if you have something like that, please reach out. We'll talk about it more in depth. Any business that's had prior government loss or delinquent federal debt. This one's really important. We had a recent experience where part of our application is we ask, do you have or have you had any delinquent or government loss? And we had an applicant check no, and then when we submitted the loan, it was discovered during application that they actually did have a government loss. And so that loan became ineligible until that was cured or they paid all of that debt. Life insurance companies, passive businesses. This one's kind of an interesting section because on one hand, it says we cannot do passive businesses like apartment buildings or mobile home parks. And yet on the other hand, we can do hotels, RV parks, campgrounds, and nursing homes. So it is nuanced, but the key here is if there are quote unquote tenants of that space that pay directly to the borrower, then that's how I would say it's classified as eligible. If the borrower doesn't need to be there, like an apartment building, then it's probably not eligible. Business has to be located in the US. And these are some of the ineligible companies going forward. Right now, no marijuana-based or related companies are eligible. No speculative business, any business that's limiting on who can participate in the business activity. You'll see some more there. Owned by persons of poor character. We do pull background checks. Certain types of crimes are okay, but if it's a felony, certain felonies make a deal ineligible. Just let us know if you have that situation early. Danny, do you have any questions? Just want to make sure I'm not going too fast on this. We good?
Nope, you're good to go.
Okay. Let's talk about project size. So there really is no limit to how big the project can be. The key is that our portion of the project cannot exceed 40% or $5 million. So in a typical situation, we wouldn't run up against the max, but where we have some larger projects like hotels or nursing homes or things like that, we may hit that $5 million cap. But it's either 40% or 5 million or both. We want to keep in mind too that if a borrower has outstanding 7A debt, that may lower their ability to borrow up to the cap. So let's say they had $1 million of government guaranteed debt in a 7A, then they could only borrow up to 4 million of 504 debt. So we have to know that as well. That's one of the reasons we ask borrowers to sign a document that allows us to go to the SBA and ask what government debt they have outstanding. Now, there are some caveats in how big or how much they can borrow. If a borrower has an eligible manufacturing project, they can go up to 5.5 million. In addition, SBA has a goal of developing or helping companies develop more sustainable projects. So they've said a borrower can do up to 3 green projects, and in each of those get up to 5.5 million. Keep in mind it's per project and not aggregate. So if I have one project and I do $1 million of SBA 504 money, and then I do a second project with $4 million of SBA money and a third project of $1 million, I can't keep borrowing. It's per project. So I can max out each project, but I can't borrow multiple times above the 3 eligible projects. That one's a little tricky, and I may have not explained that very well. So if you have questions, give us a call. One of the things we have to look at is credit elsewhere. I mentioned it earlier about that deal where the borrower had too much cash. But effectively, it's a way for SBA to determine why a government subsidized loan or government-backed loan is necessary. So in most cases, when you're working with a borrower, especially on a 504, they have limited cash. You as a lender are not willing to go typically above 75% or less, depending on the type of project. And so the borrower may not have the cash necessary to inject for a conventional program. So this allows them to put as little as 10% down. So we would cite that as one of the reasons that we need you as a partner and you need us as a partner. There may be industry risk. Maybe you as a lender typically would not lend on a hotel, but with SBA help you would, or a self-storage project or something of the like. So you need additional help. Startup, a lot of businesses are not, or a lot of lenders are not going to lend money to a startup and also require a smaller down payment. So that's a way for us to use the program to help you. Limited cash, we already mentioned. And then most lenders don't have a 20 or 25-year fixed rate loan that's fully amortizing. So this is one other way that we can say a borrower needs our help, especially right now with a rising interest rate environment. This is maybe really important to a small business that cash flows now at the current rate, but may not in the future. So we're helping them protect risk rate. So these are some of the things we look at that are a key component of credit elsewhere. We touched on occupancy. I do want to talk a little bit more about specific components of occupancy. We really address it at 2 points during our process. At application, when we get the appraisal, we look at what the appraiser says the borrower will occupy in the space. And then at closing, we also do an inspection, and then if there are any leases, we would collect those that also help us determine how much space is being occupied by our borrower. If a borrower is buying a condo unit, they have to occupy the majority of that condo unit. if they're buying 2 adjacent condo units and only plan on occupying one, but each condo unit has its own tax ID number, that would complicate the transaction because they would have to occupy a minimum of 51% of each condo. If those 2 condos had one tax ID number, then they could potentially just occupy one at 51%. We run into this frequently. So if a borrower is purchasing space and there are multiple units, we want to talk about it early. New construction has its own rules with regards to occupancy. The SBA basically is telling us that if a borrower is building something for their current use, they should be able to occupy at least 60% of that space. And with the intention of growth within their business, they should be able to occupy up to 80% within 10 years. So that does mean a borrower that builds a building could potentially lease out up to 20% of space indefinitely, but they must occupy 80%. We get this question a lot where you say, well, how will SBA know? And my answer is always that SBA can check at any time without letting us know what the occupancy is. So we want to make sure we comply with these rules. Let's go to the next one. EPCs, or holding companies, and how they relate to operating companies. The EPC, or the holding company, has to lease the entire space to the operating company. So effectively, the EPC cannot do anything other than receive rents from the operating company. So some of you may say, well, what if they want to lease a portion of their space out? The rule is that the operating company then has to sublease to that potential third-party tenant. So the tenant will actually pay rent to the operating company, not the holding company. So this can get tricky, but we can help you walk through this as we need to. The other thing with regards to the holding company is SBA feels like a holding company is not established for making additional profits. In other words, the operating company can pay the holding company enough to cover the mortgage payments, taxes, insurance, repairs and maintenance, etc. But what it doesn't want to see is an operating company paying excessive rents in as much as they could take K1 distributions. That's the way I look at it from a holding company. So in a case where SBA may determine that, well, we can talk about that later. Let me skip that. In terms of cash flow, so most banks and credit unions analyze cash flow differently than we do. We can only count cash flow derived from the operating company or operating companies if there are more than one. So if, let's say, there is a tenant in the building, they occupy the requisite amount of space, but they do receive rental income from a third-party tenant, we cannot count that income towards their cash flow. That may seem silly, but that's what SBA has determined they want their rule to be. The other component is outside income that the borrowers may receive. Let's say one spouse works for the borrowing company or the operating company, and another spouse works for a different company. We cannot count excess income from that non-affiliated company, so not our borrower, towards the cash flow. So our global cash flow may be different than yours. So the key thing to remember is the operating company needs to be able to service the debt. And then any outside income not derived from the operating company cannot be counted towards the cash flow. The other thing is most lenders will have a minimum debt service requirement of 1.2 to 1. Some are higher. Because your global cash flow is derived slightly different, we may be okay with 1 to 1 or better with tax returns and financials because of how we analyze the credit differently. So just because it doesn't meet a 1.2 to 1 debt service coverage ratio does not mean it's not eligible. So we can talk about that when you have a specific deal. Prior government financing. We mentioned earlier that one of the things that makes an SBA 504 loan eligible or ineligible, sorry, is that it cannot have previous government losses. So if they've defaulted on a government loan in the past, it's a non-starter. If they've defaulted but paid that debt back, they could be eligible. If they're currently in default, typically they are ineligible. So how do we know if they've defaulted? Well, hopefully they tell us. Hopefully when they fill out our application, they tell us they have. If they don't tell us, we will, as part of our application, collect the signature, and that allows us to go to our SBA district office and have them do a previous government financing check. It's a certain type of search. We do this on every loan. So if they fail to mention it up front and we find out later, it will kill the deal. So there are workarounds. If they've defaulted and are willing to pay the debt back, then we can work through it. If they are not, then it's no longer eligible for SBA financing. SBA requires an environmental at some level. And in most cases, that can be a transaction screen. We strongly prefer RSRAs in lieu of what's called a VeriCheck. If you don't know what an RSRA is, we're happy to tell you. An RSRA typically gives us the exact information we need to have it be an eligible report. If a particular building had or will have certain types of operating companies in it, it may require a phase 1. So for example, if there's ever been a gas station, or if it's a building that previously did auto body work, even though our borrower may not be doing the same type of work at that space, SBA still will require a phase 1. So if you have something that you think may be eligible or may require something other than an RSRA, please let us know so we can get that ordered early. And as part of that, we have to have a reliance letter and insurance. And sometimes if lenders order those on their own, we may not get that, so we have to go back to the environmental professional. Appraisals. So anytime, I'm going to skip to the bottom and then go back to the top of the slide. If total project costs or the estimated value of the property is less than $500,000, we do not require an appraisal. If an appraisal is required, you'll see the list of really the key components of an appraisal. It has to have SBA listed as an intended user. It has to have 2 methods of valuation. If there is only one, which has happened before, we need a really strong case as to why. So, but typically we need 2 methods of valuations developed within the appraisal. It has to have an as-is value and an as-complete value. So if someone's, for example, if they're, let's say they own a building and they're improving it, adding additional space, we have to have the current value plus what it would be when that that new component of the building is built. If it's a brand new building, same applies. If, let's say we're doing this, I put this in here this morning because I was thinking about a particular deal, but if we have a storage project, typically the appraiser will give us an as is, as complete, and as stabilized value. We cannot use the as stabilized value for our analysis. So we really like when the appraiser gives us occupancy, tell us exactly how much of the space of the building the borrower is occupying. And in some cases, it may be obvious, but we still like to have that. We also want the remaining economic life of the property listed. And it has to be equal or greater than the SBA loan. So if we're trying to do a 25-year deal, the remaining economic life has to be 25 years or more. Franchises, if a deal has a franchise component, we want to know right up front. If they're on the directory, we have to get it approved. If it's not an approved franchise or an approved agreement, we actually have to submit this for approval through SBA. So we need to make sure that if there's a deal that's not currently listed as a franchise or has a membership distributor agreement or fuel supply agreement already approved, we need to do that right away. We can't move forward with a deal until it's approved by the franchise department, which is in SBA's legal department. Loan documentation, pretty straightforward. I would say this is, if you need it, we probably need it. And we need at least 2 years, sometimes 3. We need current interim financials. So this is kind of a unique time of the year where most companies that have filed extensions don't have their 2021 tax returns. So you'll notice that we're requiring copies of the extensions, and then we need current interims. And this includes all companies that we've used in our analysis. So the holding company, the operating company, and any affiliates. The signed application, this is crucial for us to be able to pull certain reports, credit, and that prior government financing report that I discussed. So what if a loan gets declined for eligibility? Is it dead? I'm pretty ambiguous here on purpose because it really just depends why the deal got declined. If it's something we can overcome, for example, let's say a company changed ownership of an existing 504 loan, so they're considered technical default. Well, if we can cure that default, then they might be eligible. If SBA determines that they aren't eligible, but we can give another reason why we think they are and SBA accepts it, then yeah, we can probably do the deal. The thing we want to remind you is we try to vet eligibility way farther in advance than by the time we submit it. Usually when SBA has made a decision, we've already addressed eligibility as well as we can. So seriously, we will do our best. Again, we're always learning because SBA changes the SOP, but we'll do our best to address eligibility up front. And if we do our job right, the cases of declines based on eligibility are very much minimized. I feel like that went really fast, but it looks like it took us about 35 minutes. We're trying to stay around 40. So hopefully that gives you enough time to contemplate some questions.
Just really quick, Brooks, the primary questions that kind of filed in that we answered on the fly there pertain to how to unlock the green energy policy $5.5 million per project. And just really briefly there, the most popular by far is solar energy production because it tends to be the most cost effective and also the easiest. So what I mean by that is, in order for a deal to classify as a green energy project, opening up $5.5 million of eligible proceeds per project, the site just has to produce 15% of the energy required to run the site. And so that typically comes at a pretty nominal cost. Where we see that quite often is hotels. Multiple hoteliers are looking to do multiple projects, and each time they're expending the full allotment. The amount of energy needed to produce, or amount of solar arrays needed to produce a 15% energy is pretty nominal considering the size of the project. We've also seen some on car washes, assisted livings, others where people, the borrowers, have come back to the 504 well wanting to do several large projects. The other thing you can do outside of energy production is energy reduction, and you have to show a reduction of 10% energy on site. This is a little more difficult to claim through the SBA, just because you have to have a like building to kind of run that analysis off of. So really the times that we see this will be like in a phase 2 expansion or major remodel of an existing building that the OC is in. One that I was able to process a couple of years ago where we were able to do that, it was a large hospital type facility. And we went in, and as part of the project cost, did LED lighting retrofit to the whole building, and it met that 10% reduction requirement. So I guess a question might be, how do I reach that 15% solar array production or the 10% reduction? There are companies such as Partners Engineering and others that provide essentially an energy appraisal, and they will sign off that the amount of solar arrays needed will meet that 15% classification. So if you're interested in pursuing those, get in touch with us early. We can put you in contact with the engineering firms that can kind of make all of our lives easier, so that we don't go to the SBA and SBA says, oh, I don't trust this analysis of getting to the production or reduction. Taking a look at the Q&A, that's really the only question that came through. So just really appreciate everyone's time. Brooks, turn it back to you to do a wrap up.
Great, thanks. Like I said before, it's our goal to be the experts in eligibility so that you don't have to be. But if you have any questions about eligibility, let us know up front so we can help you navigate it if it's tricky. Next month, we'll be doing even more on eligibility. This will be the deep dive, in case you have brain space for more, and that's going to be handled by Curtis Singleton, who he does channel a little bit of Mike Vancheri in terms of the SOP. So please invite anybody that might be interested in more in-depth look at eligibility to join us on that one. That's all I got. Thanks.
Thanks, everyone. This concludes our session. We really appreciate your business and look forward to seeing you in person at some of our events this summer. Thanks.